Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
We're still early in the year. The AI trade and the Bitcoin trade have been dramatic as of late. It's a time of rapid change. If you're approaching retirement, this is probably stressing you out. A sweeping sell-off in software and services stocks should be a wake-up call if you're a retiree or heading towards retirement. Your portfolio needs to be well diversified. Things like gold that used to be more of a safe haven, not really fitting that bill right now. We're in a period of rapid change. The retail investor, younger people under 35 years old in particular, were drawn towards Bitcoin with disillusionment with both Biden and Trump, with the jobs market. Now it turns out that their attention may be shifting to AI, but international markets look attractive. Non-U.S. markets aren't nearly as tech-heavy as the S&P 500. They're getting a big benefit from a weakening dollar, which is down 7% against a basket of major currencies. Geopolitics tend to drive the dollar, which often moves in long cycles. So the depreciation that began in 2025 could last maybe up to a decade. Should you sell America? I don't think so, but you should have a strong case for investing in your U.S. assets, including tech innovation and artificial intelligence. AI may be hurting some software and services industries, but it's also expected to give a big boost to U.S. productivity, which is a positive for economic growth. Should you lock in gains? I don't know your portfolio. I'd love to get to know your portfolio and get to know you and see what you're doing right and wrong. Good event coming up this weekend, Pints and Portfolio. More on that in a few minutes. The 5 years before your retirement are the red zone, when you have to be cognizant that you're susceptible to the sequence of return risks. We talk about that on a regular basis on the show. Big tech capital expenditures soared in 2025. It's going up another 50% in 2026. I'm going to tell you if I'm giving up on AI or not by the end of the segment. Amazon, Alphabet, Microsoft, and Meta spent nearly $400 billion on CapEx in total last year, mostly in service of buildings out the AI infrastructure that they hope will furnish their futures. 2026 is getting more expensive. Those four, Amazon, Alphabet, Microsoft, and Meta, are expected to spend 50% more in 2026 than in 2025, roughly $600 billion. Amazon is on the hook for $200 billion in CapEx this year. Google expects to spend between $175 and $185 billion. Meta, not that far behind, as 2026 CapEx would be about $115 to $135 billion. Microsoft didn't give an estimate, but analysts have its 2026 calendar CapEx right around $114 billion. Analysts' expectations for 2026 were way lower than the reality when the companies reported earnings and gave us an update. The AI supply chain is soaring thanks to Amazon's CapEx budget. Amazon's plan for $200 billion in the business investment this year was the exclamation point to end the reporting period that saw every Magnificent Seven hyperscaler provide higher guidance. So not the hyperscalers, but everyone else is benefiting. Applied Digital, CoreWeave, Nebius up 16.2%. Chips, the usual suspects, big winners. NVIDIA up 7.3% to 184. Broadcom up 7.2%. The AMD up 8%, pushing the S&P 500 close to its all-time highs. Makers of racks for the AI servers, Supermicro up 9.3%, Dell up 4.2%, the power companies like Oklo up 13%, NewScale up 16%. So this week we got the hyperscalers saying we're going to spend billions and billions and billions more, sometimes double what you were expecting. And the secondary plays are the big winners. But that leaves the primary plays, the Magnificent Seven. What do we do with these guys? So the AI trade changed in 2026. The AI trade didn't collapse, but it narrowed, it hardened, and became far less forgiving. What began as a broad optimism-driven theme has morphed into much more selective, scarcity-driven trade. All the bullish oxygen has been sucked into scarcity. The market has decided that near-term bottlenecks matter more than long-term narratives. The global shortage of high-bandwidth memory has become the dominant expression of AI exposure, funneling the capital into a handful of firms able to monetize that constraint immediately. Semiconductor capital equipment makers have benefited upstream, reinforcing the same message that scarcity is rewarded, abundance is not. CapEx is no longer being taken on faith. Massive AI spending plans were applauded almost reflexively. This year, they're being interrogated. Again, the numbers that the Magnificent Seven are reporting on spending for capital expenditures on infrastructure 3 to 6 months ago may have caused their stocks to move up 10 to 20% instead of down 10 to 20%. Meta is a good example. Despite strong execution and visible AI-driven growth, gains haven't stuck. The market's asking a harder question. When does the spending translate into durable margins? Not just faster top-line revenue growth. We need to see the margins. That's important. The biggest consumers of AI inputs are getting squeezed right now. Qualcomm being a notable example, faces supply constraints that are the most acute. Waiting behind giants for critical inputs has become a real earnings issue, contributing to cautious outlooks and muted stock reactions. AI demand is strong. That access to the tools required to monetize that demand is uneven, and markets are punishing that imbalance. AI is now being framed as a threat, not a tailwind, for much of public software. AI has increasingly become a negative theme. Companies perceived vulnerable to AI-driven disruption now include a large portion of the software universe, including Salesforce.com, Adobe, and others. Solid quarters and decent guidance are no longer enough to offset that existential question about pricing power, moats, and long-term relevance. We're seeing some really cool software building technology come out of AI, especially Anthropic. A lot of these players aren't even public yet, SpaceX, Anthropic, and OpenAI this year. And before they hit the public markets, you're going to see some gas put underneath these players to get the public generally excited about AI. If AI stocks are down 10, 20, 30, 40% from their all-time highs when the IPOs roll around, no one's going to want these players. This is a buying opportunity. Leadership fatigue is real, though. It's a 2026 phenomenon for sure. It's reinforcing the mood right now. Since the end of third quarter, NVIDIA and Broadcom, the twin pillars of AI hardware trade, have gone essentially nowhere. If you look at the 3-year, 5-year, they've done very well. The leaders stopped leading, and that creates confidence from you that the theme is eroding. I believe it will shift back by the second half of 2026. Even today, on Friday, you're starting to see markets get back to within 1% to 2% of their all-time highs. That's not a rout. That's not a correction. That's not a bear market. That's a snap judgment, very similar to what we had with DeepSeek last year coming out of China, saying we can do a lot of what the AI hyperscalers can do, but at a fraction of the cost, created a buying opportunity. AI adoption is moving from infrastructure build-out to measurable productivity gains. Software stops looking like collateral damage sooner rather than later and starts looking like leverage again. Now, again, I don't own any of the software players directly. I own them indirectly through things along the lines of S&P 500 funds or growth mutual funds. In other words, summing up, the AI trade has not disappeared. It's simply moved into a more skeptical, more selective phase. That is a really good thing because back in the 1990s, we weren't skeptical. We weren't selective on .com stocks, and that ended badly. I think we're setting the stage for the next leg higher, not the end of the story. It's something you have to consult a broker advisor about before taking any action on anything. I don't think the AI trade is over. In fact, the sign of all this expenditures on CapEx, I think it's a good sign. I think that they believe in the product cycle. Now, here's the big question. It's adding long-term cost as AI infrastructure will constantly need to be replaced and upgraded every 5 to 6 years, typically. So this is future cost as well. Now, again, we're going to move from the large language models more into inferencing, which has a lot smaller footprint of CapEx. But we need to see the profit margins continue to improve, productivity gains across America improve. Stay long the AI trade in select scenarios, but pick the right vehicles. I have a Pints and Portfolio Saturday, February 7th, tomorrow. Saturday, Pleasant Hill, California, 12 to 2. It's a good chance to talk with a financial planner about capital gains and your taxable income, creating tax efficiencies. I'm going to bring 2 CFPs with me and a mortgage lender. Saturday, February 7th, 12 to 2, Pleasant Hill, California. Complimentary portfolio review. What's your financial plan? What are you doing right? What are you doing wrong? Do you have an income strategy in retirement? Sign up for the event at robblackshow.com. That's robblackshow.com. That's Saturday, February 7th, 12 to 2. Get there early because the 2 hours flies by and I buy the beer. We'll talk about Google and Amazon's quarter. What did I make of them?
Saturday, February 7th, join Rob Black in Pleasant Hill for Pints and Portolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by between noon and 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, February 7th, noon to 2 in Pleasant Hill. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this event in Pleasant Hill and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Joining me today, Tony Mendes with Bay Area Loansource.com, a division of Classic Home Loans. He's been my mortgage lender for 20 plus years, probably a little bit longer if I were to examine the data. He will be with me this weekend, Pleasant Hill, California, 12 to 2 in Pleasant Hill. Saturday, February 7th, it's Pints and Portfolio. It's a great opportunity to meet financial planners, to meet myself, and to meet a realtor / mortgage lender type who can help you with your questions. Absolutely free. I'll buy the beers. Sign up at robblackshow.com. That's this weekend in Pleasant Hill, 12 to 2. All questions answered. Plus, you'll get a preliminary plan after the event, which you should take me up on. Let's talk with Tony about adjustable rate mortgages. I have to imagine that they're still around. It's something I really learned about in my 20s as I was starting to think about buying a home. Did I want the 30-year mortgage, the 15-year mortgage, an adjustable rate mortgage? Question marks abounded. I've never done an ARM, which is interesting. What's happening in the world of adjustable rate mortgages, Tony?
They're not as popular as they were back in 2005, 6, and 7, pre-Great Recession. In fact, we were using about 70% of all purchases back in 2005, 6, and 7 were adjustable rate mortgages. That dropped immensely through the Great Recession down to about 2%, 3%. Post 2008, the average was about 6% usage for buyers and refinances. And that's jumped since we've seen rates increase because you get that little discount when you get an adjustable rate mortgage. It's up to 12.9% in November of 25, the latest data. So we're seeing a lot more people being interested in the adjustable rate mortgages because they offer that anywhere between a half a point to a point lower than a 30-year fixed.
It's interesting because in my head, I was always afraid of the risk of the A in adjustable rate mortgage of adjusting higher. Also, I was buying homes in my 20s and 30s when rates were dropping. Therefore, I was like, okay, it's going to get better. It's going to get better. It's going to get better. And then it's going to get worse. And I was worried about that getting worse part. How often do you think people actually run into the adjustable rate mortgage adjusting into problems?
You would have seen that just recently when rates went up. So if you were to get an ARM pre-COVID, for example, and you had a 5-year ARM and now rates have gone up, your 5-year fixed period is over and you become fully adjustable, your rate would have increased quite a bit. So the whole theory here is when rates are high, you get an adjustable rate. When rates are low, you get the fixed rate. So going through COVID, we didn't do any ARMs during COVID because rates were so low, it would have been silly to do one. But as rates have increased, then that philosophy comes into play where you want to take something that helps you on a mortgage, on a monthly payment, and helps you qualify. That's the other part of this. Some of the rules have changed that allow people to qualify at what they call the start rate. It used to be if your rate was 5%, for example, but they would qualify you at 7% because they feared that the rates would go up, just like you do. So they've changed that rule for some of the programs like the FHA and first time home buyer program. And it allows people to qualify at the start rate. So more and more people are using the adjustable rate mortgages with FHA for a purchase because they can qualify for more money. So that's another incentive. But to answer your question, a lot of people do fear that. In fact, it's the number one question is what happens to my rate once that fixed period is over? We have to prepare for that. For example, if you move around a lot, let's say your job moves you every 5 years, you're the perfect candidate for a 5-year loan because you're going to sell your house and never have to worry about that. Meanwhile, you have the lower rate and the lower payment. But if you're going to stay in your house for a long period of time, you don't want to worry about the adjustable period and those fluctuations, then it's probably not the right product for you. That's why we've seen a lot more awareness come out of the Great Recession and the mortgage blow up, is that people are more cautious and I think wiser when it comes to decisions. Not saying that this isn't a wise decision. It's just more people they can't get sold it so easily as they did back in 2008, 9, 10, and so on.
Now, I'm in my 50s and I have a rental property that I've almost paid off. And it's got an incredibly low rate, so I don't want to pay it off. And yet I'm at the point where I've got maybe 18 more months or less of those payments. So I'm starting to think of my options. Do I want to do a home equity line of credit, pull some money out, some equity, and put it into another property, put it into an investment, put it into fixing it up? Or do I want to do a DST, a Delaware Statutory Trust, and move that rental into kind of a REIT and get the equity that's generating income higher than 2% rate of return cash flow, more like 4 to 6%. So I'm at an area where I have questions. So help me with the HELOC side. And this weekend, a certified financial planner can help listeners with the DST, Delaware Statutory Trust side. What do I need to know about HELOCs currently, Tony?
Well, there's a lot of equity in homes. I think we hit, I can't remember the numbers, like 13 or 14 trillion or something like that. I think in those like 62 or older, for example, they have a record of 14.3 trillion in home equity somewhere in mid 25. So there's a lot of money to access that's in your home, but just like you have a low interest rate on your first mortgage. Right. And unless your aggregate rate is lower than combining the HELOC and the first loan together in a new loan, unless that payment is higher, lower, it makes more sense for you to get an equity line or what they call a fixed second. So an equity line is actually an adjustable rate mortgage in a way. It's an open-ended second, and it will fluctuate over a period of time. But they've come out with some hybrids too, in case you don't like the adjustable part. You can get a fixed HELOC now. So what it allows you to do is it gives you basically it turns your equity into a bank account where you can draw off that money. And you only pay interest off of what you've drawn, your balance. So you can get a $100,000 equity line, but only draw off the required amount. They say $25,000, for example, pay that back over a period, pay some credit cards or put it in another investment, and then always have that $75,000 accessible. So it's not a bad thing to have, but you have to read the terms. A lot of these have shorter draw periods. They're usually set up for a 10-year interest-only period, 20-year repayment plan, and a 30-year amortization. That means that you'll have 3 years to draw or 5 years. 10 years of that payment will be interest only on whatever your balance is. You have a 20-year balloon, which means you have to pay the loan off in 20 years. And then if you do principal and interest, it's amortized for 30 years. So that's the basics behind it. But it's just about how you can access the equity in your house without touching your first mortgage. Now, there are some cases where you need $200,000 or $300,000, but you only owe $100,000 on your first. Sometimes a cash out refinance where you combine all the money together is a better financial scenario for you on a payment wise. However, you have to take all the money out at once. So the HELOC gives you a lot more flexibility about when you take the money out and what you're making payments on.
This is something people can come to the event this weekend, the Pints and Portfolio. They can talk to you. They can talk to me about stock picks. They can talk to a financial planner about tax efficiency, where they stand in retirement planning. But let's talk about the final topic with you on reverse mortgages, because a lot like you mentioned with adjustable rate mortgages and with home equity lines of credit, there's a lot of options out there, including. Thanks very much. It's Tony Mendes. You can find him at BayAreaLoansource.com. He will be at the Pints and Portfolio. He will be available to take your questions and help you with real estate and mortgages and lending. He's been my lender for quite a period of time. The Pints and Portfolio is this weekend, Pleasant Hill, California, February 7th, 12 to 2. Sip, socialize, get your financial questions answered. I'll buy the beer for a couple of hours. We'll talk about Super Bowl, who you're betting on. We'll talk financial planning, real estate. Are you ready for retirement or not? I'll bring a CFP. Sign up at robblackshow.com. That's robblackshow.com.
This interview featured on The Rob Black Show is brought to you by EP Wealth. Learn more at robblack.com.
I've got an event coming up Saturday, February 7th, 12 to 2 in Pleasant Hill. It's a Pints and Portfolios. That's an event where we sip, we socialize, and we answer your financial questions. I'm bringing some experts from EP Wealth to answer questions. I'm also bringing a mortgage lender. So we got everything covered from stocks to financial planning to retirement issues and much, much more. It's Saturday, 12 to 2. Complimentary portfolio review, as well as a preliminary plan. What are you doing right? What are you doing wrong? Are you diversified enough? Are you not? How are you feeling with the current market corrections? Seats are limited. Sign up today at robblackshow.com. That's February 7th, 12 to 2 this Saturday. Let's bring in one of the people that I'm going to be bringing to the event for the first time ever, Nathan Rogers. He is interesting because he is a JD, a CMT, and he's also got a master. So he's got a lot of education tied towards his financial advice and insights. Nathan, tell me a little bit about one of the products that we can discuss on Saturday. It has an odd name. I don't think retail investors know what an AQR Delphi Plus is. Am I saying that right?
You are.
Okay. What's it all about?
Yeah. So, Rob, for so many years, we in this business have been looking for more and better ways to create greater tax efficiencies for clients.
Okay.
And we've gotten very good at this. I think you've talked previously about strategies like long, short, direct indexing and certain ideas that are relatively new, but very powerful. And the last bastion of tax efficiency that was on the table that was very difficult to address is that, especially where we live, we have so many people with very high incomes. And even if their incomes are just reasonable, they oftentimes have RSUs that can be very large amounts. In addition to that, we have clients that have IRAs, in some cases, very sizable IRAs, but there's no powerful motivator for getting it converted to a Roth because they're in this set of years where their income is too high to justify it. So that's where AQR TA Delphi Plus comes in. This is a very specialized product. I should say upfront, it is not for everybody. It's very particularized. It is a hedge fund. But what the program is meant to do is create the possibility of a W-2 income offset. Or if somebody doesn't need the W-2 or RSU income offset, we can use it to help them convert Roths and do that very efficiently. So the idea, and I'm just going to give you the basics. Let me know if you want me to go any deeper because this stuff gets fairly deep.
Sure.
But the idea is that the client enters this hedge fund, this AQR Delphi Plus hedge fund. It is organized as a trading partnership. By virtue of it being a trading partnership, they get a status as a designated tax trader. And that designated tax trader status actually allows any losses that occur within the fund to become ordinary losses. And the distinction between ordinary losses and passive losses is that most of the time our investment losses are passive, and we only get to write them off against other passive gains. In this case, it's different than that because those losses get shifted into the ordinary category. We can actually subtract them right off of the W-2, right off of the RSUs, right off of the IRA conversions. And there's some things that need to be understood. There's ratios of how much money you need to invest in order to get a certain benefit from using the strategy. But basically, this is the first thing that we've been able to provide in a fiduciary context that gives people the ability to do those incredible things and create those offsets. Does that all make sense?
Absolutely. I have a couple of follow-up questions because when I got into this industry in 1990s, hedge funds were all the rage. And I actually had a choice, Nathan, of starting an RIA or starting a hedge fund. And because the fees were higher on hedge funds, I talked myself out of it. And then there was a lot of bad press where hedge funds would either hit a home run or strike out. And there was some bad press where they get a percentage of your profits back then. And that seems to make them want to take more risk. Now, you're talking about tax efficiencies in this one. Mm-hmm. So that seems to be more up my alley. Am I right with some of my ramblings there?
Absolutely. It is a thing where, as with anything we talk about, we have to educate our clients so that they're coming into this eyes wide open. Although it's structured differently than the hedge funds you're describing, it still has hedge fund type characteristics,
sure.
For example. Yeah, absolutely. And in addition to that, you can get periods of non-correlation. That is both a positive and a negative of a hedge fund, because you've seen how that works. There are times when that non-correlation is to your benefit, and there's times where it's to your detriment. That's a communication process. What we like to do with people is make sure that as they consider a strategy like this, they have a really good grasp of why they would do it, what the potential benefits are, what the costs are, and what the potential detriments are, because there are always things that can go in unanticipated ways. So it's very much a communication process, but it is a powerful strategy. And I think something that makes EP unique, something I really like about EP Wealth as a firm, is we don't just jump into these types of strategies. We do very significant due diligence before we ever make these things available. And this has been through our in-firm due diligence process. We don't outsource that. That's becoming a more popular way that RIAs do their due diligence. And not to say we would never use somebody else's report, but in this case, we did all the vetting ourselves. We believe we can offer it in a fiduciary way, but that doesn't mean it's for everybody. It requires some explanation, and it requires understanding of what the potential benefits and pitfalls are, because there's always a tale of two stories. There's never only good. Does that make sense?
Absolutely. And I think what we're talking about is, and when I say retail investors, it's a generic term for people who are out there who aren't working with a financial planning firm like an EP, who has access to institutional products like this that can be implemented with a lot of oversight and making sure that it's appropriate. But with the typical average person, say your neighbor, when they do Roth conversions, they hate the idea of paying taxes. It sounds like this is a plug-in between the person and the conversion that's right in the middle of it that helps cut down on those tax efficient, or creates tax efficiencies, so that the tax hit isn't so bad when you're doing the conversion from a regular account to a Roth account, which you don't pay taxes on. So it's interesting. Am I getting that right? That it's in the middle?
Rob, you are nailing it. Okay. You're doing very well, which we didn't talk about this ahead of time. So I love that it makes sense so quickly. And I would just add, in addition to potentially being able to offset taxes, depending on the amount of the investment that one places into Delphi, you could actually neutralize them. You could turn Roth conversions, because you can structure the investment in a way where you can project the approximate amount of ordinary losses that you're going to get through the fund, and you can convert according to what you get. And because a conversion doesn't have to be done to the end of the year, you don't have to take the risk of doing the Roth conversion up front and then finding out, oh, it didn't work out as well as I thought. You can do the conversion later in the year when it's more evident.
Sounds about right. What else do we need to know about this product, or have we wrapped it up?
I think that's actually really good. I think for anybody who's curious, I can talk in more detail. I can tell them about the non-correlation risk, talk to them about costs, because you also mentioned costs of hedge funds. They are more expensive. They do, in some cases, including Delphi, some pretty powerful things, but there's a price you pay. So you need to understand that. And we can talk more about that in person if people would like.
I've got a financial planner with EP Wealth, Brad, and I've gone into that scenario of reducing my taxable income and my capital gains due to working with a tax efficient process and products that are geared towards that. So I get the idea, but if people want to learn more, it's a good chance to sit down and talk to you on Saturday. What are some of the other products out there that, just give me one more product that you like in the world of financial planning that's available for financial planners, but not necessarily for the retail investor?
Yeah. So something else is I have become a supporter, if it's properly used, of private allocations and incorporating more private allocations. And this is, you said one thing, private is a bigger category than just one, but these could include examples like private credit, which can be a very useful investment in an IRA, private real estate, which can make a very tax efficient private investment, private equity. That's not always so appropriate. That depends on somebody's risk tolerance. So I don't emphasize that one, but we also talk about private infrastructure. And just a concluding note on those, it's all about finding things that help you produce a portfolio that has a more balanced risk-adjusted return. And those are supplements. They're not majorities. Rob, what you do is the bread and butter, right? But these are supplements.
Sounds good. It's Nathan Rogers. You can meet him Saturday, February 7th, 12 to 2, Pleasant Hill, California. Show up early because getting access to experts it's invaluable. It will help you with your financial planning and your decisions. Get to know what a financial planner does, complimentary portfolio review, as well as a preliminary plan. Terribly informal. I'll buy the beers. We'll have a good time. We'll talk sports. We'll talk investing and much, much more.
Saturday, February 7th, join Rob Black in Pleasant Hill for Pints and Portolios, a less formal event at a local watering hole for those close to retirement with $500,000 or more in investable assets. Drop by Saturday from noon to 2 p.m. in Pleasant Hill for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or are already there, this financial snapshot can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. Go to robblackshow.com and click the events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide you all the details on the location of the event in Pleasant Hill and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Saturday, February 7th in Pleasant Hill, noon to 2 p.m.
This week we got earnings out of Alphabet and Amazon. Alphabet's latest earnings did more than deliver a strong quarter. They provided a real-time case study for how the AI trade is evolving from the narrative-driven enthusiasm into a capital-intensive, return-focused regime. If earlier phases of the AI trade rewarded belief in optionality, the current phase rewards scale, integration, balance sheet strength, and the ability to absorb near-term pain in pursuit of long-term control. Alphabet sits at the center of this trend. Its results, capital spending plans, and market reaction capture the tension that allocators now face across the entire AI ecosystem. Extraordinary operational momentum is being paired with skepticism towards the magnitude and timing of returns on capital. I would say this is a start and stop, an ebb and flow angle that I want you to grasp so you can survive it. Alphabet's fourth quarter and full year results reinforced why it remains one of the most powerful businesses ever constructed. Revenue grew at 18%. Annual sales surpassed $400 billion for the first time, and growth was broad-based across search, cloud, YouTube, and AI-driven products. The breadth matters here. Unlike narrower AI plays, Alphabet's earnings are not dependent on a single monetization lever or technology cycle. Advertising continues to throw off enormous cash flow. YouTube has quietly become a global media platform, generating more than $60 billion in annual revenue. And cloud is transitioning from proof of concept to a proof and profit engine. Alphabet can fund the future using the cash flows of the present. Part of their capital expenditures also are tied towards Waymo, the self-driving cars, and not AI. Search was supposed to be disrupted. Instead, it's expanding. I look at Google as a government-sponsored monopoly at this point in time because they were deemed by the government of the United States to be a monopoly, and they couldn't really figure out how to punish them last year. That's one of the reasons you want to own Alphabet/Google. AI-enhanced search is driving higher engagement, increased query volume, and improved monetization. Rather than hurting search, AI appears to be deepening user reliance upon it. For a business that remains Alphabet's economic engine, this fundamental change helps the risk profile enormously. Google Cloud delivered 48% year-over-year growth alongside expanding margins, signaling a shift from experimentation to execution. They have what OpenAI wants. They've got emails. They've got storage. They've got a full ecosystem of users right now, both on a business and consumer level, that they're starting to leverage intelligently. Alphabet is beginning to quantify traction in generative AI. The Gemini app now has approximately 750 million monthly active users. The company processes roughly 10 billion tokens per minute through its API. Those figures are still early, but clearly they're establishing a relevance at consumer and developer levels simultaneously. Alphabet is a lot like Netflix. They've got 325 million paid subscriptions across consumer services. The ecosystem depth is a form of risk management. Alphabet's revenue mix makes it harder for any one disruption to derail the whole trade. They're issuing bonds now, 50-year bonds. I think that's the time horizon that I have on them. Over the past year, Alphabet has outperformed much of the Magnificent Seven, including Apple and NVIDIA. This shift changes the narrative that AI leadership automatically belongs to the hardware or consumer device champions. Alphabet's experience mirrors the broader AI regime shift. Scarcity still rewards upstream suppliers like NVIDIA and Broadcom. Hyperscalers such as Microsoft, Amazon, Alphabet are absorbing margin pressure in exchange for long-term leverage. Software companies face uncertainty as markets struggle to price future value capture. Let's move on to Amazon. Amazon's latest earnings reports triggered a familiar reaction. The stock slid after a modest earnings miss, softer near-term profit guidance, and most notably a staggering capital expenditure approaching $200 billion for 2026. The response was anxiety over margins, skepticism about returns, discomfort with numbers so large they feel almost abstract. That's the short-term investor. That's not me. At the surface level, Amazon's fourth quarter results were not weak. Revenue grew 14% year over year to $213 billion. Amazon Web Services revenue rose 24% to $35.6 billion, driven by strong demand for AI workloads and outpacing Wall Street expectations. Subscription revenue, led by Prime, increased 14%. Wall Street loves subscriptions. Operating income guidance, $16.5 billion to $21.5 billion versus expectations of $22.2 billion, reflects spending choices, not demand deterioration. Amazon Web Services remains central to Amazon's long-term thesis. The cloud business continues to grow faster than the broader company, fueled increasingly by AI-driven workloads. Demand for training and inference capacity is accelerating. Customers are committing to a longer-term infrastructure contracts. AI workloads are capital-intensive, sticky, and deeply integrated into customer operations. Once deployed, though, they're difficult to migrate, reinforcing Amazon Web Services' competitive position against Microsoft's Azure and Google's cloud. Amazon Web Services is not simply a cloud business. It's a toll booth on enterprise adoption. One of the most underappreciated aspects of Amazon's AI strategy is its investment in custom silicon. Trainium and Graviton chips now generate a combined annual revenue run rate exceeding $10 billion. A lot of their CapEx is going into making these chips for themselves and for others. They offer customers lower cost alternatives to third-party accelerators while improving Amazon's own unit economics. For the big allocators, custom silicon is a signal that hyperscalers are no longer content to rent critical inputs. They intend to control them. Amazon's plan to invest roughly $200 billion in capital expenditures during 2026 dominated the narrative. The figure is enormous. It requires average daily spending north of $500 million. And understandably, it's unsettling. I get all that. Margin compression as a strategy, not as failure, is the theme that I want you to walk away with. Near-term margin pressure is explicit cost of Amazon's strategy. Operating income guidance disappointed because the company is accelerating spending ahead of the revenue realization. This dynamic's uncomfortable for people in the public markets, but one of Amazon's enduring strengths is the diversity of its revenue streams. Alongside Amazon Web Services, advertising has become a high-margin growth engine. Physical retail, while less glamorous, generates scale and data. Subscriptions create recurring revenue and customer lock-in. It allows Amazon to fund massive investments without relying on external capital markets as smaller or more narrowly focused competitors. For allocators, this breadth reduces existential risk even as headline numbers grow larger. I'm Rob Black, talking all things financial. Want to know what I'm buying and selling? Come to my Pints and Portfolio this weekend, Saturday, Pleasant Hill, California. That's February 7th, 12 to 2. Get there early. We'll sip, we'll socialize. I'll bring a CFP, a mortgage lender, and myself. Connect with like-minded investors, get answers to your most pressing questions. Free portfolio review after the event, as well as a preliminary financial plan. That's tomorrow, Saturday, February 7th, 12 to 2 in Pleasant Hill. Sign up for more details at robblackshow.com. It's free.
Saturday, February 7th, join Rob Black in Pleasant Hill for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by between noon and 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, February 7th, noon to 2 in Pleasant Hill. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation and your confirmation email will provide all the details on the location of this event in Pleasant Hill and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.